Yeah, so in this case, we are looking at group accounts. We are looking at group accounts. So in this case, on special transaction number 1, so that is intergroup sales. Intergroup sales and unrealized profits on closing inventory. Intergroup sales and unrealized profit on closing inventory. So we had done an example there. And I think we were getting the URP. In this case, we were getting something like the URP. The URP is equals to 24,000. The URP is actually equals to 24,000. And we said how you end up having to treat this one when you are consolidating the income statement. When you are consolidating the income statement and also consolidating the statement of financial position, these are you likely end up having to treat this one. So we said in this case, what will happen, you likely debit the cost of sales, or in this case, can people say the retained earnings, because it will be an expense. Then in this case, you likely end up having to credit the closing inventory. So when you credit the closing inventory, it means you're having to do what? You're having to deduct. You're having to deduct. When you debit the cost of sales, you're having in this case to do what? To add. You're having to add. So this is how you'll be able to treat what? The unrealized profit on closing stock once you've actually been able to calculate it. So you'll be advised in the additional information. So what will happen, for example, for this closing inventory, you'll be given the balance sheets of two. You'll be given balance sheets of two entities. Here, we'll have in this case for the parent company, and in this case what for the subsidiary. You'll have the balance sheet. So this is the balance sheet. So this is what you'll be able to see in the question. So under, in this case, the current assets, under the current assets, you'll see closing inventory. Maybe they have said here it is actually maybe 4 million. It is actually maybe 6 million. It's actually in this case what 6 million. So like that. Or maybe in this case we can be able to say maybe 60,000. 60,000, and this one is actually 40,000. So what is happening in this case under consolidation? We said consolidating is having to combine the books of the parent company with those ones of the subsidiary. So what will happen here, if you are preparing now the final statement for the consolidated one, statement of financial position, when you come in this case under current assets, you are consolidating. What is happening? You are combining the two. You will say closing inventory. This will likely be 40,000 plus 60,000. Then you make that adjustment. In this case, say minus 24,000. You will say like that when you are consolidating. You will add for the two, the parent and the subsidiary. But now you eliminated this amount because you're having to say what you credit the closing inventory. So that's what will be happening when you're coming up with the final statement as the statement of financial position. So you add the inventory for the parent company, you add that one in this case for the subsidiary, but now you deduct the URP. You deduct the URP to get the correct closing stock by the end of the period. So that's what in this case we mean by having to do what? To credit the closing inventory. To credit the closing inventory. I want us to look at another example. Then we see sometimes you can actually be given the markup. You're supposed to, in this case, to convert to the margin. Because in this case, if you are calculating, in this case, the unrealized profit, you in this case utilize the margin on the selling price of the goods to the other entity. So there's another example. We can be able to look at example 2. So we already looked at example 1. So you can go to example 2. Example 2. So you can write example 2. Example 2, you can write A Limited controls B Limited by 90%. So A Limited controls B Limited by 90%. A Limited controls B Limited by 90%. During the post-acquisition period, during the post-acquisition period, so A Limited controls B Limited by 90%. During the post-acquisition period, B Limited sold goods to A Limited. So B Limited sold goods to A Limited. B Limited sold goods to A Limited. A Limited worth 120,000 shillings. Shillings 120,000. Shillings 120,000. Shillings 120,000. At a markup of 20%. 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 So assuming the goods were still in stock. Assuming the goods were still in stock. Assuming the goods were still in stock. Assuming the goods were still in stock by the end of the period. By the end of the period. By the end of the period. Assuming the goods were still in stock by the end of the period, determine the unrealized profit on closing stock. Determine the unrealized profit on closing inventory or stock. Closing inventory. Determine the unrealized profit on closing inventory or stock. The unrealized profit on closing inventory or stock. So what in this case you realize here, it is that in this case you've actually been given the markup. In fact, you can be able to underline here. You can be able to underline here. You've actually been given what? The markup. But in our previous example, we had actually been given what? In our previous example, we had actually been given. In our previous example, we had actually been given what? The margin. We had actually been given the margin. So in this case, you've been given the markup. Take note, you have to convert that markup to a margin before you calculate the URP. If in this case, you've actually been given the markup, you have to convert that markup to the margin. Before in this case, you end up having to do what? To calculate the URP. Before you actually end up having to calculate the URP. To calculate the URP. And then in this case, you have to convert this one. You have to convert this one into what? Into a margin. You have to, in this case, convert this one into a margin. So there's in this case what we call what? Conversion. Conversion of markup. Conversion of markup to margin. Conversion of markup in this case to what? To a margin. Conversion of a markup in this case to a margin. Conversion of a markup to 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 margin. So in this case, for example, if you can look at what I'm going to say here. If in this case you have a markup, if you have a markup, hope you can be able to write this one in the corner of your book or somewhere. But I'm just having to write here. If in this case, conversion of what? Markup to margin. If you have a markup, let's say in this case you have a markup of, in this case, let's say for example, a quarter. So what will be the margin? If you have a markup of, in this case, a quarter, what will be the margin? Who can be able to try? What will be the margin? Let's assume you have, in this case, a markup of a quarter. The margin will be? The margin in this case will likely end up having to be a fifth. It will be a fifth. So what happens here? What happens here to get the margin? To get the margin, we'll in this case say 1/4 plus 1. 1/4 plus, in this case, what? 1. You take in this case the numerator here. You can come and actually add on what? On the denominator. So like that. You come and actually end up having to add on what? On the denominator. So for example, in this case, if we have the markup having to be 20%, in this case, the markup is 20%. So let's assume we have this situation here. Markup is equal to 20%. And of course, you know what 20% means. 20% means 20/100. 20/100. Therefore, this means margin will be what? Therefore, this means margin will be will be a sixth, or in this case, you can be able to say 20 over 120. Without, in this case, having to do a lot of mathematics, you can just say 20 over 120, which in this case is actually what? A sixth. It is actually a sixth. Exactly in this case, what? A sixth. Exactly a sixth. So what happens in this case, if you have a markup, you just take the numerator of the markup and you add on the denominator. You likely end up having to get what? The margin. And if you are converting the margin to the other way, it means you deduct. You deduct. So in this case, it means it will actually be 20 over 120 minus 20 to get what? The markup. If you are going this side. If you are going this side, or if you are going this side. So if you are going this side, you take in this case what? The numerator, you add on it, the denominator. And therefore, in this case, the margin will likely be 1 over 4 plus 1. So in our situation here, it means our margin will likely be 20 over 100 plus 20. So our margin will likely be 20 over 100 plus, in this case, what? 20. So you have to, in this case, master what? The conversion of a markup to, in this case, what? A margin. Then in this case, you can be able to use what is example here. You can actually be able to use this example here. So in this case, simply take what? The numerator of the markup, you add on the denominator, you likely end up having to get what? The margin. Get the margin. So that's why in this case, you do what? The conversion. And of course, this concept is common in the exam. So they'll in this case confuse you by having to give you the markup. So the examiner wants to frustrate you. He'll give you the markup. So you've forgotten you're supposed to convert the markup to the margin, because ideally this is the selling price of the goods. They were sold to the other one at the selling price of the goods. So you have to, in this case, get what? Get the margin. You have to get the margin because this is what? The selling price. This is the selling price. And that in this case, that's as to why in this case, you convert that one to a margin. And therefore, if you're having to look at, in this case, what? The solution. So we can be able to look at the solution. You having mastered these things of markup margin. You having mastered these things of markup margin. Then in this case, this thing is just becoming now very easy. It's just becoming now, in this case, what? Very easy. So first of all, you have to do what? Elimination of the intergroup cells. So what you have to do first of all, eliminate the intercompany cell. The intercompany cell. The intercompany cell, of course, is likely 120,000. So in this case, it means we likely end up having to debit the sales account. But in this case, what? Shillings, 120,000. This basically means we are deducting from the sales. Then in this case, we credit the cost of sales. We credit in this case what? The cost of sales account. Cost of sales account with the same amount, shillings, 120,000. When you credit the cost of sales account, it means you are deducting from the cost of sales. This is an expense account. When you credit it, it means you're having to do what? To deduct. Then number two in this case, you likely end up having to do what? To determine the unrealized profits, and that in this case, you'll likely also be able to do what? Account for it. So determine the unrealized profit. Determine the unrealized profit on closing inventory. Determine unrealized profit on closing inventory. So to get this one, we're having to say, you'll in this case take what? The margin. You multiply by, in this case, what? The selling price. You in this case multiply by what? By the selling price. The selling price. But of course, in this case, you haven't actually in this case been given what? The margin. So you've actually been given the markup. You've actually been given the markup. So the markup, you are going to say the markup is equals to 20 over 100. The markup is equals to 20 over 100 as per the question. The markup is equals to 20 over 100 as per the question. So the URP is equals to margin multiplied by the selling price. The markup is actually 20 over 100. Therefore, margin is equals to 20 over 100 plus 20. Therefore, in this case, margin is equals to, take the numerator, you add on the denominator, you'll get the margin. Therefore, margin in this case is equals to 20 over 100 plus 20. And that in this case, it is equals to what? 20 over 120. So with this now, we can actually be able to get what? The URP. So in this case, it means we'll take 20 over 120 because that is the margin. Then in this case, we multiply by the selling price of the goods, which was in this case what? 120,000. You get what as the URP? You get what as the URP? Is it 20,000? 20,000 or something. You'll get 20,000, you get 20,000. You get 20,000 as the unrealized profit, or in this case, what? The closing inventory, as the URP on the closing inventory. And therefore, with this one now, we can actually be able to account for it. We can actually be able to account for it. We're having to say this one will debit the cost of sales. Will debit, you continue after this one, you continue down there, you will debit the cost of sales, or in this case, the retained earnings account, in this case, an amount of 20,000. If you are debiting an expense account, it means you are adding. It means you're having to add. If you are debiting an expense account, you're having to add. Then in this case, you credit the closing inventory. The closing inventory account. This means in this case, you're having to do what? Within this case, shillings 20,000. So this means you're having to do what? Deduct. You are deducting from, in this case, what? The inventory. If you credit an asset account, it means you are deducting. So that's what in this case could have actually ended up having to do what happened there. Could have actually ended up having to happen there. So take note, if you are given the markup, you have to convert to the margin because the goods are sold to the other member of the group at the selling price. At the selling price. That's what in this case you need to be able to take note of. So I want us now in this case, we look at now the second adjustment. Very common also in group questions. 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 So in this case, we have what? The intergroup balances. Intergroup balances. Remember, the first one is intergroup sales. And in this case, what? URP on closing inventory. So number two is what we call the intergroup balances. Intergroup balances. Intergroup balances. So the intergroup balances. So you can be able to write this about intergroup balances. This refers to intercompany indebtedness. This refers to intercompany indebtedness. It refers to the intercompany indebtedness. Is where one member of the group owes the other one. Like in this case, you know, they are like in this case supplying goods to each other. The parent company supplies goods to the subsidiary on credit. So that subsidiary has not been able to pay. Or the subsidiary supplies to the parent, and the parent company has not actually been able to pay. It will bring about what? An intergroup balance. An intergroup balance where one member of the group is owing another member of the group. One member of the group is having to owe what? Another member of the group. So in this case, the parent company is having to owe the subsidiary, or the subsidiary is having to owe the parent. So it's exactly either way. It is either way. So or in this case, you might be wondering what is indebtedness. It is a case where a member of the group owes another member of the group. If this one happens, you have to eliminate the indebtedness. You have to eliminate it. So in this case, you have to end up having to do what? Eliminate the indebtedness. So in this case, the intergroup balances will be eliminated as follows. So in this case, the intergroup balances will be eliminated. This elimination seems in this case is a common now vocabulary. The intergroup balances will be eliminated as follows. You have to eliminate them, remove them. You have to eliminate them, or actually end up having to do what? To remove them. So how you'll end up having to remove them, you'll likely in this case debit the trade payables, and you credit in this case what? The trade receivables. So you will in this case debit trade payables. So this means you're having to do what? Deduct. When you debit, this is a liability account. When you debit it, it means you are reducing it. you are deducting it. And then in this case, you'll credit the trade receivables. You credit the trade receivables. In this case, you deduct. So that means you'll likely end up having to deduct. You'll likely end up having to deduct. You know, in this case, you're talking about a group. So in this case, you have the parent, just to be able to demonstrate. We have the parent, and of course, in this case, what the subsidiary. So you'll likely be given, in the question, you'll likely be given, under, in this case, what? The current assets. You'll be given the trade receivables. You'll be told the trade receivables of, in this case, P is maybe, in this case, what, 40,000. While in this case, for S is actually maybe what, 30,000. Then under the current liabilities, you'll be told that the trade payables of, let's say, for example, the parent, let's say, for example, in this case, for the parent, is actually maybe 60,000. Then this one is actually maybe 72,000. So like that. You'll be told like that. You'll likely be told like that. Then you'll likely be told in the additional information, by the end of the financial year, so P was still having to owe. By the end of the financial year, maybe in this case, P was still having to owe S, maybe in this case, what, 10,000. By the end of the financial year, which in this case, you are preparing the consolidated financial statements. This P was still owing S 10,000. Was still owing S 10,000. So you have to remove this one, because you know what is happening when you're having now to consolidate. What is happening? So as basically consolidating is bringing them together. So in the consolidated statement of financial position, when you are putting them together, you will say the trade receivables is equals to 40,000 plus, in this case, what, 30 minus, in this case, what, 10, because you are deducting here. Then in this case, for the trade payables, you'll say 60 plus 72 minus 10. Minus 10, minus 10, minus 10. The reason why in this case you have to eliminate, if you don't eliminate it, it's like you are doubling. When in this case you are combining them, it's like you are doubling them. You're like in this case having to double them again. Remember, these entities are preparing what? Separate books of accounts. Separate books of accounts. Separate books of accounts. So it means if you combine them without having to eliminate this one, you are still basically accounting for it inside here. It is already inside here. Like this amount, let's say, for example, in this case, if this P is having to owe this one, huyu ako na deni ya huyu. Huyu ako na deni ya huyu. Inamaanisha, it means this 10,000 is already inside here. You get the case? So in this one, prepared separate books of accounts. And in this case, it means he's still having to owe this one what? When you owe the other one, you become, in this case, what? He becomes a trade payable for you. But in his books of accounts, he becomes a trade receivable. So in this case, it means this S has accounted for this 10,000, which this one is owing him inside this one. And this guy has accounted for this 10,000, is owing this one inside this one. So to him, this one is a trade payable. To him, this one is a trade receivable. So this 10,000 that is still owing this one, when you prepare these separate books of accounts, this amount is inside this one. While this amount that is expecting from P is inside this one. So when you combine, it means it's already inside here. It's already inside. It has already been accounted for inside there. So in this case, you don't remove it. It's like in this case, you're having to double. You're like in this case, doubling already. You're having to double. So then in this case, you have to do what? Remove it. You remove it. You eliminate that what? Intercompany balance or intercompany what? Owing. So you have to remove it. So that's what will be happening. So you'll be given the trade receivables, trade payables. So when you are consolidating, if you are told there was an intercompany owing, you will consolidate by having to say trade receivables 40 plus 30 minus 10. Then you say trade payables 60 plus 72 minus 10. So like that. So what in this case you just need to know, just master. If there's in this case an intercompany owing, we eliminate. We eliminate it like that. We eliminate it like that. So that's what in this case will likely end up having to do it to happen. That is in this case what will likely end up having to happen. So sometimes in this case something can happen. Something can happen. It can be that this amount, of course, this guy is still having to owe this one 10,000. So they have accounted for it in what? In the trade receivables. But now maybe this guy has already sent a check that is yet to be received at the other hand. He has already in this case sent what? A check to reduce his what? Payables. But it has not actually been received at what? At the other end. We call it cash in transit. cash in transit. Sometimes in this case, there can be intercompany owings or balances with what we call cash in transit. Already this P, he has accounted for it. He has reduced it here already because he has paid. But now this guy has not received it. He has not received it because it is in transit. Maybe they have sent what? A check that is on the way. So the money is actually yet to be received. The money is actually yet to do what? To be received. That in this case, kind of a transaction, we call it what? Cash in transit. One of the parties in the group has already accounted for it. But the other party hasn't accounted for it, that he has received it. He hasn't reduced these receivables, because in this case, he's yet to do what? Receive it. But this one has already accounted for it. He has already reduced what? His payables. He has already reduced his payables, but now the other party has not actually been able to do what? Receive it. So if that is the case, you'll likely in this case end up having to debit the cash in transit. You debit the trade payables. Then in this case, you credit what? The trade receivables. Remember, the trade receivable guy, the S, he has not received it. And therefore, the trade receivables remain the same. But already, this guy, he has sent the check. He has accounted for this guy as what? As a payable. He has already sent the check. And therefore, he has reduced this amount already. It's only that the other party is yet to receive it. So for him, he has already removed, maybe if it was 5,000, he has already removed 5 here. So it means that 5 is under what? Cash in transit. And therefore, in this case, under the trade payables, we won't actually eliminate the entire amount. In this case, we'll actually end up having to do what? Further debit another transaction here we call what? A cash in transit. Cash in transit. That one is also another trick by the examiner. So let's see in this case, if there's a cash in transit, which one do you debit? Which one do you end up having to do what? To credit. So let's write in this case, if there's a cash in transit, you can be able to write this. Sometimes there can be a cash in transit. There can be a cash in transit. So how do you deal with cash in transit? One of the members of the group has already paid. He has already even accounted for it in his books of accounts. It's only that the other party in the group is yet to receive. Yet we are combining. So if you don't account for this cash in transit, then it means we'll in this case end up having to mess with what? The mathematics there. So you can actually be able to write any cash in transit need to be adjusted before any cash in transit needs to be adjusted before eliminating the intercompany owings. Any cash in transit needs to be adjusted before eliminating the intercompany owings. The following entries will be passed in the books of accounts. The following entries will be passed in the books of accounts. The following entries will be passed in the books of, in this case, what? Accounts. The following entries will be passed in the books of accounts. You can be able to underline this one, cash in transit. Underline it, cash in transit, a very key concept under intercompany owings. So the cash in transit comes under what? Intercompany owings. Well, in this case, intercompany sale of goods arises what? URP, or unrealized profit on closing stock. So if this is the case, you'll likely in this case debit. You'll debit the cash in transit, debit the trade payables, and you credit in this case what? The trade receivables. In this case, you'll debit the cash in transit. You'll debit the cash in transit. Then in this case, you'll debit the trade payables. Debit the trade payables. Then you credit the trade receivables. Credit the trade receivables. You'll likely end up having to credit in this case what? The trade receivables. So like that. Credit the trade receivables. You credit the trade receivables like that. 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 So what constitutes the verification of cash in transit? The person will be able to know there is cash in transit is the person who has paid. So there's no any other verification. The person will be able to know there's cash in transit is the person who has actually ended up having to do what to pay. So if it's the parent company that has paid, they'll know. But in an exam situation, the examiner will tell you if there's a cash in transit. So he won't give you the headache of you having to verify. It won't be your problem to verify. It will be the examiner to tell you. So unless maybe you are an auditor. So if you are an auditor, that will be your problem now to find out, to verify. But in the exam, the examiner will tell you there was a cash in transit. So it won't be something that you'll start thinking, is there cash in transit or not? He'll straight away tell you of this amount that is owed by the subsidiary to the parent. There was in this case what an amount of, in this case already 10,000 that has been paid that is yet to be received by, in this case what, the parent. But in other normal circumstances, obviously the person who has paid is the one who knows he has already paid. The other party is not aware, he's just waiting until the money hits his account, or in this case he receives the check, is when he'll be able to know indeed that they have paid. Indeed they have paid. Indeed they have ended up having to do what? To pay. They have actually ended up having to pay. They have ended up having to pay. They have ended up having to pay. So let me see whether I'll be able to get an example. Whether I'll be able to get an example. Let me see whether I'll be able to get an example, so that we can be able to see how that cash in transit might actually end up having to arise. Cash in transit can actually end up having to arise. Cash in transit can end up having to arise. You can look at August 2024. I don't know whether you'll be able to get that past paper. August 2024. Even we might be able to get it. August 2024, question number 2. Look at August 2024, question number 2. Just open that question. Just open that question. August 2024, question number 2. August 2024, question number 2. August 2024, question number 2. So once you're there, you can actually be able to say yes. Yes, we are there. You can actually end up having to say yes, we are there. So August 2024, question number 2. So are you there? Have you been able to get it? Have you been able to get it? So have you been able to get it? So just get the illustration. With the illustration now, you'll be able to get what I'm having to say. So hope you've been able to get it. Look at note number 6. Don't look at the entire question, because I can tell you, if you look at the entire question, you might start shivering. You might start shivering. You just look at note number 6 and forget about everything. Just forget about everything and look at note number 6. Look at note number 6. So look at note number 6. It says Excel Limited or 𝗙𝗢𝗥 Limited 200 million. So if in this case you look at this question, so if you look at this question, the introductory paragraph, you are told in this case, the following information was extracted from the financial statements of Excel Limited, 𝗙𝗢𝗥 Limited, and Z Limited as follows. Then if in this case you look at note number 1, Excel Limited is actually in this case what? Excel is the parent. Excel is actually what? The parent company. Is actually the parent company. And then in this case, it made some acquisitions. In this case, in what? 𝗙𝗢𝗥. And in this case, the other one. So 𝗙𝗢𝗥, and in this case, the other one, which is actually in this case, what is Z. But as to whether they are subsidiaries or not, we just forget about that one, first of all. So look at what in this case you're having to be told. Excel Limited or 𝗙𝗢𝗥, Excel Limited, this parent company, or this one. So that's what? An intercompany or way. So that is in this case what? You need to write the question. So it is December, it is August 2024. August 2024, question 2, not August 2024, question 2, not 6. Not 6, or additional information number 6. Additional information number 6. So if you look at that one, in this case, what is having to happen there? It is that this Excel Limited owed what? There was an intercompany owing. So there's in this case what? An intercompany balance. An intercompany balance of 200 million. So in this case, 200 million. Whereby in this case, this Excel Limited order, yeah. So it means this amount is supposed to be paid this side. It's supposed to be paid this side. Then you are told this. The books of Excel, however, showed that it owed YEP. In this case, what? 160. So this guy, Excel owed YEP. Excel owed what? YEP. In this case, how much? 200. But now these books of Excel showed they owed what? 160. They owed what? 160. And then you are told Excel Limited had sent a check to YEP Limited. They already sent a check to make part of the payment of this 200 million. But the check was yet to be received. So the check was yet to be received. So Excel Limited had sent a check to YEP of, in this case, what? On 24th of June, which was not received by YEP until 2nd of July, which in this case was already the end of what? The financial year. So it means in this case, there was what? A cash in transit. There was a cash in transit of, in this case, how much? 40 million. 40 million. That's why in this case, you can be able to see that in this case, for this Excel, he has already accounted for it. YEP is yet to account for it because now in this case, he's yet to receive it. Remember, YEP is reporting Excel as a trade receivable. While in this case, Excel is reporting YEP as a trade payable. So for him, this creditor known as YEP, he has partly paid already what? 40 million. He has already accounted for it and reduced in his books of accounts to 160. But this guy is yet to receive the check. So for him, he's still accounting for these trade receivables as having to be what? 200 million. So in this case, there was what? A cash in transit. There is a cash in transit. There is a seat. There is a seat, CIT, of, in this case, how much? 40 million. There's a seat of, in this case, 40 million. There's a seat of 40 million. And therefore, if this is the case, this is how you're having to see you account for this what? Cash in transit. Therefore, in this case, what will happen? You'll have to debit what we call cash in transit. Cash in transit, you'll have to debit cash in transit. In this case, how much? You'll have to debit the cash in transit with, in this case, an amount of, in this case, what? 40 million. Then in this case, you debit, you eliminate the trade receivables. You eliminate what? The trade payables of 160 because it's an intercompany owing that is still there. The intercompany owing is still there in the books of Excel, which in this case you have to eliminate. You have to eliminate from the trade payables only 160 because that is what is still remaining as the trade payables. Already 40 has been paid. You eliminate that. So in this case, you debit trade payables. Trade payables, you eliminate that. Trade payables of, in this case, what? 160. Then in this case, you credit. In this case, this one, they are still reporting the entire amount of 200. Yep, they are still reporting the entire amount of, in this case, of 200. And therefore, in this case, you credit trade receivables. You credit trade receivables of, in this case, an amount of what? 200 million. And of course, you complete the double entry. You can see the debits are basically giving you 200. The credits are basically giving you what? 200. And therefore, you would have actually been able to complete that. This cash in transit, what will happen when you are preparing your statement of, in this case, what? Financial position. The consolidated statement of financial, this cash in transit, this one. You see, this is how you basically be able to treat it. So in this case, you'll likely be given, this is basically what you'll be able to see. And in fact, you can be able to see it in the question. I don't even have to tell you. If you look at, in this case, the question, they have given, in this case, what? They have given you the trade payable, trade receivables and trade payables. The trade receivables, you can be able to see, you've actually been given an amount of, in this case, what? There's an amount of, in this case, just look at the statement of financial position. You've actually been given an amount of, in this case, 640. So in this case, what will be happening? You'll take 640 plus, in this case, what? 600. Then in this case, you eliminate this 200. You eliminate that, what? 200. You eliminate that, what? 200 like that. You eliminate that 200 like that. You eliminate that 200 like that. Then you go to the trade payables. Trade payables, you likely go to the trade payables. Trade payables, you likely, in this case, you've actually been given an amount of, there's an amount there, which you've been given 600 and 700. You'll say 600 plus 700. Then you'll minus this one, 160. 160, you'll likely end up having to minus that one. How much? 160 like that. 160 like that. Then on the cash, there's a cash. There's cash also. There's cash. I think there's cash. Bank and cash balance. In this case, you have bank and cash balance. You have bank and cash balance. What will happen when you are consolidating? You will take 200, is 200. You take 200 plus 100. Then you add on this cash in transit. You see this 40, you'll add it here. You'll add it here. You'll add it there, you'll add it there because you are debiting. Cash in transit is money. So you'll add it here because you are debiting an asset account. You'll add it there when you're consolidating. So like that. But now for the trade payables, because it's a liability, you'll actually basically deduct. This means you're having to deduct. I don't know whether I had actually indicated to you. This basically means you're having to add. This one means you're having to deduct. You're having to deduct. When you credit and trade receivables, you're having to deduct. That's why you're ending up having to deduct it here when you're having to do it. Consolidate. Alternatively, you can be able to report this cash in transit as being separated. You just consolidate these ones on their own. Then here you indicate another asset when you are consolidating cash in transit 40. Cash in transit 40 like that. So this is basically now we'll be able to in this case do what? Make the adjustments in the final accounts. This one is usually very easy to adjust, especially in this case if you've already been able to master it. It doesn't have complications like the other one for in this case what URP. Once you've been able to master this one, debit trade payables, credit trade receivables. In fact, you can be able to do it even without having to do a working. You can do it without having to do a working. So if you are told in this case those are intercompany owing, we normally eliminate it. How do we eliminate it? We simply debit the trade payables, we credit what? Trade receivables. If there's a cash in transit, we'll further debit that cash in transit with that amount. Then the difference, we debit what? The trade payables. And in this case, you would have actually been able to do what? Master it. You would have actually been able to master it. So that's basically in this case how you deal with what? A cash in transit if it is there. If this cash in transit was not there, it means in this case, you would have actually been able to do what? Debit the entire amount of 200 in the trade payables. In this case, assume there was that intercompany owing of 200. But there was no, in this case, what? These issues of cash in transit. It means this one wouldn't have been there, wouldn't have been there. It would have actually been 200 here. So it means what we've been doing here, we'll be deducting 200 both sides. Then there was no issue of cash in transit at all. If in this case, it was not there. So we would have deducted here 200 and we come and actually deduct here how much? 200. And of course, we would have actually been able to clobber that one. Would have actually been able to clobber that one. So I can be able to see or not able to see down there. Trade receivables, there's trade receivables down there. The 600 and 700 is inventory. So it is inventory. So you can be able to check the trade payables. Trade payables is what? Are you sure? Are you sure? Or it is inventory. So it's 640 and 340. 640 and 340 is actually 340 here. You can just be able to correct, but of course you are not doing the equation. So we'll be able to now, when you do the full illustration now, you'll be able to see how you finally adjust them. But this is basically how you deal with them. So you'll be able to put here 340. You'll put here 340, the correct figure, like that. But that's how in this case you do what? You deal with them. So I don't know whether you've been able to finish that one. So that is in this case another adjustment that you have to master. That one is normally easy. It doesn't have a lot of issues. Once you can be able to master it, you just, in fact, you can do it without even having to do what you are working. You just put those ones you add. Just put those ones you add. Then in this case, you can actually be able to do what? Deduct. Trade receivables and trade payables. Are you not able to see or you want me to repeat? You're not able to see or you want me to repeat there? I can see you're not able to see there. Let me put the camera for you so that you can be able to see. So I think there it's better. There it's better. You want me to repeat or you want me to show you the way it's supposed to be there, like that? When you say pardon, there's the debit trade payables 160, debit credit trade receivables 200. So that's how in this case we deal with what intercompany owings. It also never misses in a group question. It will be there. It is very common. It is very common. So the intergroup balances. Then we can be able to go to number 3. We can have in this case what we call what? Intergroup sale of fixed assets. This is another special adjustment. Intergroup sale. Intergroup sale of fixed assets. There can be another situation where a member of the group sells fixed assets to the other member of the group. So how do you deal with it? How do you deal with it? How do you deal with it? So this is a sale of a fixed asset by one member of the group to another member of the group. It is the sale It is the sale of a fixed asset by one member of the group to another member of the group to another one member of the group to another member of the group. So this one can actually end up having to happen. This one can actually end up having to do what? To happen. So in case of this kind of a transaction, two major adjustments in this case will likely end up having to be made. So in this case, two major adjustments will be done. So in this case, right? In this case, two major adjustments will be done. Two major adjustments will be done, i.e., which are these two major adjustments? So in this case, one member of the group sold a fixed asset to the other member of the group. There are two major adjustments that will likely end up having to do. Will likely end up having to be done. Will likely end up having to be done. So first of all, you likely, in this case, the asset was actually sold at a profit, and that is majorly what will likely be common in the past papers. They'll tell you that in this case, an asset was actually sold to the other member of the group at maybe a profit. So you have to eliminate that profit. So eliminate any profit recognized on the sale of the fixed asset. So part A, first of all, you likely eliminate any profit recognized on the sale of the fixed assets, fixed assets. You likely in this case, first of all, do what? Eliminate any profit recognized on the sale of the fixed asset. Eliminate any profit recognized on the sale of the fixed asset. You'll first of all, in this case, eliminate any profit recognized on the sale of the fixed assets. Eliminate any profit recognized on the sale of the fixed assets. And in this case, you eliminate it. You likely in this case end up having to debit the cost of sales. You in this case debit the cost of sales, or in this case the retained earnings account, or in this case you can be able to say the P&L account, the P&L account. So in this case, it is actually cost of sales. You'll likely be adding on it. So in this case, these are profit. You likely in this case end up having to remove it. You likely eliminate it. So in this case, debit the cost of sales. So that in this case, you recognize it, you reverse it by putting it in what? In the cost of sales expense. So you will in this case eliminate that what? Profit. You put in the cost of sales or expense account. Then in this case, you credit the plant, property, and equipment account. In this case, you credit the PPE account. Credit the property, plant, and equipment account. The property, plant, and equipment account. So in this case, it means for the P&L account, you likely basically be adding as an expense. Well, in this case, for the property, plant, and equipment account, because it's an asset account you're crediting, it's like you likely be removing it. You'll likely be eliminating that what? Profits. That are likely in this case done what? Been recognized. You'll likely be removing it. Then, because in this case, the asset was recognized at a profit. The asset in this case recognized, the purchase price of the asset was recognized at a profit in the other member of the group, whom in this case they sold to. Then in this case, it means that asset, like in this case, you're having to say, A sold an asset, in this case, what? B. A sold an asset to B. These are basically members of the group. So these assets, they in this case sold it at maybe, they'll tell you they sold it at maybe 400 or maybe 40,000. This was the selling price. This was in this case what? The selling price. So you have it, the examiner will tell you that they sold this asset to this other one at a margin. They'll tell you a margin of 10%. They tell you in this case they sold at a margin of 10%. So this now the profit you're having to say you'll have to eliminate it. So in this case, you'll calculate the profit on sale. In this case, which will likely be it will be 4,000 because in this case it will be 10% multiplied by 40,000. So the selling price at which they sold this asset to the other member of the group B, it was 40,000. Then the examiner tells you they sold this asset to the other member of the group at a margin of 10%. So when you see that, it means in this case there's what? There's an intergroup sale of fixed assets where in this case they have recognized a profit. And therefore you're having to say you eliminate it. You have to eliminate it. So in this case, take 10% of this, which in this case will likely end up having to be 4,000. So with this 4,000 is only having to say you come and actually put it in the cost of sales account, or in this case in the P&L account. And if that is the case, it means in this case, you'll likely basically be adding to this expense. You'll be adding to this expense. You'll likely be adding to this expense. Then you'll go to the PPE account. To the PPE account, you'll likely in this case do what? Eliminate it. You'll likely eliminate this 4,000 here. You'll eliminate that what? 4,000 there. You'll eliminate that 4,000 there. You'll eliminate that 4,000 there. So it means in this case, you'll likely be deducting here 4,000. And also you'll likely be adding here to the cost of sales 4,000. So like that. To the cost of sales in this case, what? 4,000 like that. 4,000 like that. So that's what in this case will happen if the asset was actually sold at a profit. Calculate the profit on the sale. Then in this case, eliminate it. How do you eliminate it? You'll likely end up having to debit the cost of sales because you reverse it. Remember, in this case, initially it has been credited, but now in this case, you'll end up having to reverse it. You'll likely reverse it by putting it as an expense, or in this case, debiting the retained earnings. But commonly in this case, you'll put it in the cost of sales. This is basically what will be common with our questions. We'll be seeing cost of sales. This is where we majorly make most adjustments. Cost of sales is where we make most of the adjustments that happen here under group. So this one will have to be put here as part of what the expenses in the cost of sales. And then in this case, you'll likely end up having to credit what? The property, plant, and equipment. Property, plant, and equipment. That's in this case what will likely end up having to happen so that you remove it. You remove it. Then you know what will happen. You see, when they sell it at 40,000, this company here, B, would have recognized it at cost of 40,000. Would have recognized it at in its books of accounts, it would recognize it at 40,000. At 40,000. And then it means when they are calculating their depreciation, they base it on, in this case, what? The 40,000, which they recorded when they bought it from this one at an amount of, in this case, what? 40,000. So in this case, it means they likely end up having to record the cost of these assets in their books of accounts at what? At 40,000. But in this case, we have corrected the PPE account. We have corrected what? The property, plant, and equipment account. You have reduced it by what? By 4,000. So it means there's a problem with our depreciation calculation on property, plant, and actually what? Equipment. And then we'll have to make that adjustment as adjustment number 2. Remember, initially, they were calculating depreciation when in this case, this amount was already included. But now we have removed it because in this case, we have eliminated what? That extra amount, which was what? A profit when they actually sold it. Then in this case, it means when they were calculating their depreciation normally, they were including this 4,000 in their cost of the asset, which was in this company, which is basically cumulative the amounts of what? The PPE. So there is what? A depreciation of what? Overcharge, because they were calculating based on what? An amount having 4,000, but we have removed. So it means in this case, they have been overcharging depreciation. We have to remove it. That is the second major adjustment. That is the second what? Major adjustment. There's a depreciation what? Overcharge because this amount was already included in the PPE when they were calculating depreciation. But now we've realized we've corrected it. Also, we have to correct what? Depreciation, because they were calculating depreciation based on the amount that was extra by 4,000. Therefore, this PPE depreciation has a problem. We have to, in this case, do what? Correct it. We have to, in this case, end up having to do what? Correct it. So adjust for overcharged depreciation. That is adjustment number 2. Adjust for overcharged. Adjust for overcharged depreciation. Say like that. Adjust for overcharged depreciation. Adjust for overcharged what? Depreciation. Adjust for overcharged depreciation. Adjust for overcharged depreciation. Adjust for overcharged depreciation. So adjust for overcharged depreciation because it is an overcharge, because you can see the PP was recorded as a problem, but now we've corrected it. So they were overcharging. They were calculating depreciation on the extra 4,000 amount. We have in this case to do what? Correct it. We have to correct it. We have in this case to do what? Correct it. How do we correct it? In this case, to correct it, we'll likely end up having to increase the amount of the property, plant, and equipment. We correct it. increase the amount of the property, plant, and equipment, and we credit, in this case, what? The cost of sales. In this case, we credit what? The cost of sales. That's what in this case you'll likely end up having to do. So you can actually be able to write, hope you are through writing here. So that's when you'll be able to correct that depreciation on, in this case, what? The overcharge, you'll likely be able to correct it. You'll calculate the depreciation on that 4,000. Then you correct it like this. You adjust for overcharge depreciation. What you'll do, you'll in this case correct the amount in the PPE account. You will debit the PPE account. PPE account. In this case, you credit the cost of sales. You credit the cost of what? Cost of sales. In this case, credit what? The cost of sales or the retained earnings. Or the retained earnings. Retained earnings. This means what will be happening with the PPE, you'll likely be adding it on the PPE, property, plant, and equipment. If you're having, in this case, to credit the cost of sales, you are reducing it. You are dead overcharged, which means it was inside cost of sales as an expense. They had overcharged and they calculated what? 4,000. On that 4,000, they put that depending in this amount here. But now we are correcting it. We are correcting it because they had in this case done what? Overcharged. So we have to remove it as an expense. We remove it. How do you remove? You debit the cost of sales. Well, in this case, for the assets, they had made also a mistake because they were overcharging depreciation. And therefore, they had in this case reduced far much the PPE with an amount they were not supposed to have reduced. So therefore, in this case, you have to return that amount. In this case, we do what? We debit the PP account because it was an overcharge. It was an overcharge by what? By mistake, because they were not supposed to have recognized this asset with that what? Profit or for, which in this case, of course, removed. We've initially removed from PP. Then in this case, you've actually ended up having to do what? Correct the depreciation. So that's what in this case, you'll likely end up having to do what? To happen there. It will likely end up having to happen there. It will likely end up having to happen there. That's what will happen there. Yeah. So I don't know whether there's an example. So I don't know whether I'll be able to get an example. Whether I'll be able to get an example, but that's why you treat it. I don't know if they'll be able to get an example, but let's look at the others. Then in this case, eventually, we'll be able to look at an illustration. So now in this case, you can go to number 4. 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 Number 4 is dividends from the subsidiary. Dividends from the subsidiary. In this case, exactly what? Dividends from the subsidiary. So number 4, dividends from the subsidiary. Dividends from the subsidiary. We have dividends from the subsidiary. So dividends can be paid from the subsidiary. Dividends can be paid from the subsidiary. Dividends can end up having to be paid from, in this case, what? The subsidiary. So you can write dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Full stop. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Full stop. Dividends may be paid out of pre-acquisition profits. 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 Then put in brackets, call this dividend what? Pre-acquisition dividends. Pre-acquisition dividends. Pre-acquisition dividends. The dividends paid by the subsidiary before it was acquired. So we call it pre-acquisition what? Dividends. That's what you're having to say. It can be paid out of pre-acquisition profits or paid out of post-acquisition profits or paid out of post-acquisition. Post-acquisition or paid out of post-acquisition profits. Or paid out of post-acquisition profits. So this is after the subsidiaries have been acquired. So you can be able to write in brackets post-acquisition dividends. post-acquisition dividends, post-acquisition dividends, post-acquisition dividends, post-acquisition dividends, post-acquisition dividends. So we likely end up having to call it what? Post-acquisition dividends, post-acquisition dividends, full stop. Post-acquisition dividends, full stop. Then you write this. The parent company share, another paragraph, the parent company share, the parent 𝗙𝗧𝗧𝗔𝗟, the holding company, the parent company share of the pre-acquisition dividends, the parent company share of the pre-acquisition dividends is to be credited to the cost of investment. Is to be credited to the cost of investment, is to be credited to the cost of investment. The parent share of pre-acquisition dividends is to be credited to the cost of investment, So the parent company share of the pre-acquisition dividends is to be credited to the cost of investment, as follows. To the cost of investment as follows. So this is what will happen. If in this case, the parent had some share in what we call the pre-acquisition dividends, this is what will happen. You'll actually, in this case, debit, because this will be paid in cash, you'll debit cash, or in this case, bank. Then you credit the cost of investment. You credit the cost of what? Cost of investment. You credit the cost of investment. So this is what the entries you'll be able to pass. Debit the cash for bank, then you credit what? The cost of investment. In this case, you're having to say that this parent company is going to acquire the subsidiary. This is what is happening in that statement. This is what is happening with what you just said. You see, the parent company acquires, in this case, what? The parent company in this case acquires the parent company in this case acquires the subsidiary. Acquires what? The subsidiary. So in this case, the date of acquisition, let's say, for example, in this case, it is likely maybe 1st of January 2025. But now there were some dividends which in this case were supposed to have been paid before the acquisition. But now this parent company has just come in on 1st of January 2025. And yet it's being told, you paid some dividends before, so you'll enjoy part of it. You paid some dividends before, and then in this case, you'll actually enjoy part of it. And remember, when this parent company is buying the subsidiary, they incur costs. This is what we are calling cost of investment. They pay, so you're buying shares in the subsidiary. That's what you're having to say, you are controlling it. You're buying shares, and therefore there's money you're putting in. There's money you're having to do what? To put in. There's money in this case you're having to do what? To put in. You're incurring a cost. There's a cost of what? Investment. This cost of investment is normally recorded like an asset in the parent company books of accounts. It's like just like that. Just in this case, when we record what? Investments. In this case, we record investments. Like in this case, the statement of financial position as part of the assets. So this basically can be one of the key investments that can be recorded there. But now they'll be able to call it what? Cost of investment. That's in this case the cost they incurred to acquire these shares in what? In the subsidiary. And then it appears as what? As an asset in the parent company books of accounts. So maybe in this case, the cost that in this case they are supposed to incur is actually 10,000. Assuming it's 10,000. They're supposed to incur 10,000 to pay what? The subsidiary and acquire those shares. But now the subsidiary is giving them some good news. That they are telling them that in this case, when you're having to come in, we've already paid some dividends. But at least also you'll be able to enjoy it. You'll be able to enjoy it. We'll pay you 2,000. This parent company was not there. He even in this case didn't sweat to get that kind of dividends because he was yet to come in. This was basically the back years 2024. Huko nyuma. In fact, he had not actually come into the picture. But they are telling him you'll enjoy part of these dividends. Remember, he's incurring a cost on this debt to buy. But immediately he comes and they tell him there's part of the pre you'll actually be able to enjoy 2,000. It means this cost will reduce by 2,000. This is what is happening here. You are giving him 10 and they are giving you 2. As you give them 10 on first, they are telling you there's 3. You are getting 2. It basically reduces what? This cost of investment. But now in this case, it increases cash at the bank, because in this case, when you are paid that 2, it goes to the bank. But now your cost of investment, ideally, it won't be 10. Realistically, likely be 8, because you are being given 2 and you're just coming in. So that's what will happen. But now in this case also, they can be the post. There can be a share in 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 the post. So if the parent company has a share in the post-acquisition dividends, if the parent company has a share, if the parent company has a share in the post-acquisition, remember the other one was pre, in the post-acquisition profit. This one's now he's there, he's in the company, he's already coming. So these ones, 2025 moving forward, those are post. These ones are being paid when he's there now. He has actively participated, he's a shareholder. So he's part and parcel. So these are suite that now having to pay during post. If the parent company has a share in the post-acquisition profits, this is basically the post-acquisition dividends. This is now in bracket for the post-acquisition dividends. The post-acquisition dividends. It will be accounted for as an income. It will be accounted for as an income. It will be accounted for as an income as follows. It will be accounted for as an income as follows. And that in this case, you debit cash or bank, then you credit investment income. Which in this case will likely end up having to go to the P, L, likely go to the P and L, and go to the P and L, it's likely go to the P and L account like that. It will likely go to the P and L account like that. It will likely go to the P and L account like that. It will likely go to the P and L like that. So you are through with that. So I want to go to, in this case, now the mother of them all. We want to go to the mother of them all. This one is the mother of them all. We call it goodwill. So now in this case, number 4 is the computation of this number 5. Is it number 4 or number 5? In this case, number 4 or number 5. I think number 5. Because the other one was actually what dividend from. That's the number 5. The mother of them all. The mother of them all is what we call goodwill. Goodwill computation. This one is the mother of them all. Goodwill computation. Goodwill computation is the mother of them all. Is the mother of them all. Is the mother of all them all, because it is a key computation when you are doing consolidation. Goodwill. In this case, it's a key computation. In this case, you are doing what? Goodwill. So goodwill on acquisition. Goodwill on acquisition. It's a very key computation, this one. Goodwill on acquisition. So if this one you know how to calculate it, when you pro a financial reporting, group accounts, if this is one of them, there are like 3 of them. If you master them when you pro a group, and we saw a group tena. Ukishashika hizo tatu when you pro, at least in a group, those will be, it's very easy. This one, goodwill on acquisition. In this case, you have retained earnings, then you have NCI. If you master these 3 and you understand how to calculate them, when you pro FR group accounts, So if you master those 3, they are the most complicated to calculate. Under group accounts. If you master to calculate them, you just know in this case, you are done and dusted with this topic you are calling group accounts. So goodwill on acquisition. So you write this about goodwill on acquisition. IFRS 3 defines goodwill as IFRS 3 defines goodwill. IFRS 3 defines goodwill. IFRS number 3 defines goodwill as future economic benefits defines goodwill as future economic benefits arising from assets. Future economic benefits arising from assets. Arising from assets that are not capable, arising from assets that are not capable of being individually identified. Future economic benefits arising from assets that are not capable of being individually identified. So future economic benefits arising from assets that are not capable of being individually identified. Future economic benefits arising from assets that are not capable of being individually identified. In the layman's language, in this case, when you talk about goodwill, it is basically, in this case, value attached to this company you are acquiring. But in this case, you cannot actually be able to, like in this case, touch, or maybe in this case, feel it, but the value is there. You can be able to see it. It's only that in this case, you can't actually be able to tell which asset is far much contributing so much to this value to be there. We can't really, in this case, like be able to say which asset is actually contributing, like in this case, so much for this value to be there. But of course, you can be able to see the value is there when you're having to acquire what this subsidiary. You can see the value is there, but you can't really be able to, in this case, say this value has been as a result of a specific asset or utilization of maybe a specific resource. But now the value is there, you can be able to see exactly what's there. For example, you're in this case having to acquire the subsidiary. You're acquiring, in this case, the subsidiary, or in this case, you're acquiring the acquiree. While in this case, the acquiree already has actually been able to do what? Make a name in the market. And therefore, in this case, they are raking in a lot of revenue. They have so many consumers. You are coming in at an advantage, other than in this case, having to do what? Start from scratch. You are far much better off. In this case, you come in to do what? Control their affairs. Already they have what? The reputation, the brand is there. They already, in this case, connected to what? A number of consumers or customers, which in this case, you can't be able to get, in this case, even if you start what? A business or not on scratch. So then, in this case, it means what? There's that value. There's, in this case, what? That value. Then in this case, you can't really be able to, in this case, specifically identify from which specific asset, but the value is there. So this one, you actually end up having to call it what? Goodwill. Like it's already a recognized brand that is in the market, like for the last 30 years. And then you're coming to acquire this kind of what? A subsidiary. You are coming in at an advantage, far much better advantage than in this case, you having to start a similar business at scratch. The value is there. In this case, we call it what? Goodwill. Now that in this case, we can't in this case really be able to identify the specific asset. We normally in this case base our calculation of goodwill on what we call what? Net assets. And what is net assets? It is the equity part of, in this case, what? The statement of financial position. That's why in this case, we're able to base what? Our calculations of, in this case, what? Goodwill. That's why in this case, you're having to say there's no specific identifiable assets. Therefore, you use what? The net asset to be able to calculate it. So in this case, you can be able to write and say, goodwill is generally computed as follows. Goodwill is generally computed as follows. Goodwill is generally computed as follows. I think there's one we used in this case in what? Partnership. You remember that one for partnership? That's like the general formula. But now in this case, here in group, we expand it. We expand it and bring in other issues, other confusing issues to make your life difficult. We expand it to bring in other issues to make your life difficult. So the simplest in this case one is you say what? Purchase consideration minus in this case what? The net assets acquired. In this case, you say goodwill. That's the simple one. In this case, is actually goodwill is equals to the purchase consideration. The purchase consideration. Or in this case, this is what you're having to say cost of investments. Cost of investment. You minus the net assets. You minus the net assets. You minus in this case what the net assets. Minus the net assets acquired. Net assets acquired. You minus the 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 net assets acquired. So that's in this case the general formula. The general formula. So in this case, in group accounts, there are two methods of calculating goodwill. There's what you call the full method, and there's what you call the partial method. There's what you call the full method, and there's in this case what you call the partial method. The partial method. There's what you call the full method, and there's what we call the partial method. So that in this case, you can be able to write a small title: Methods of computing goodwill. Methods of computing goodwill. Just under that, you write a small title: Methods of computing goodwill. 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 Remember, this goodwill, it is normally reported as an asset. It will be reported as an asset. When you are consolidating, once you've been able to calculate it, when you're doing the consolidation, it will appear under the non-current assets in the consolidated what? Statement of financial position. It normally appears as an asset. It is an intangible asset. It's an asset you can't really be able to touch or feel, but now it is there. And this is how you calculate it. Once you get it, you'll likely end up having to report it under what? The non-current assets in the statement of what? Financial position. It's normally reported as an non-current asset. As a non-current asset in the statement of financial position. There are two methods of having to calculate it. So in this case, the first method is what we call the full method. So in this case, we call it the full goodwill method. Full goodwill method. Full goodwill method. This is what we call the full goodwill method. The full goodwill method is what we call the full goodwill method. So you can be able to start with that one and see how in this case you'll use it, the full goodwill method. So the first one is the full goodwill method. 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 And then you can write this about it. It is where the goodwill of the subsidiary is determined as a whole. Is determined as a whole like this. Is determined as a whole. The whole of it. We determine the whole of it. Is determined as a whole. As a whole is where the goodwill of the subsidiary is determined as a whole. Full stop. As a whole, full stop. Then you write another paragraph. The goodwill comprises of the parent and the non-controlling interest goodwill. The goodwill comprises of the parent and the NCI, the non-controlling interest. The goodwill comprises of the parent and the non-controlling interest goodwill. And the non-controlling interest goodwill. That way it is known as full. the non-controlling interest, goodwill. So you take in this case the full value of the goodwill. In this case, you consider what is the goodwill of, in this case, what? The parent company itself as the controlling interest, and in this case also the goodwill of the other parties who are the minority. In this case, we say in this case the parent company has acquired 70%. It means NCI exactly what 30%. So you are taking the goodwill of this and the goodwill of this. We are combining. Now it is actually known as what? The full goodwill method. It is known as the full goodwill method. Then you write, it is determined as follows. 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 Semicolon. Then you write shillings. Put your shillings. Shillings is determined as follows. It is determined as follows. Then you put your shillings. Shillings. Then you say purchase consideration. Purchase consideration. You first of all start with purchase consideration that you put there. The figure there. You put the figure there. Then you consider the fair value of NCI. The fair value of non-controlling interests. This one majorly will be given by the examiner in the additional information. This one will be given, even the purchase consideration sometimes, but sometimes you have to calculate it. Sometimes they can hide this one. But this one, the examiner is usually very fair. He'll just give it to you. He'll just give it to you. Just give it to you. In this case, he'll tell you the fair value of the NCA, or the NCA will measure that a fair value of, in this case, this amount. So you take that figure, and when you're calculating goodwill, you place it here. So you'll add it. You'll add it. You'll add it. In fact, in this case, you're supposed to say add the fair value of NCI. Add the fair value of, in this case, what? The NCI. And therefore, you'll be able to get a figure here. Get a figure there. Then once you get that figure, you'll less the net assets acquired. In this case, you'll actually less what? The net assets acquired. You less the net assets acquired. You less the net assets acquired. Less the net assets acquired. The net assets acquired. So the net assets acquired is basically the equity portion of, in this case, the subsidiary. The equity portion of, in this case, what? The subsidiary. The equity portion of, in this case, the subsidiary. And therefore, the equity portion will likely comprise of the ordinary share capital. So you can be able to put the amount here. You can have share premium, share premium, share premium. You can have share premium. Have share premium. Then there are now two other key figures. You have to be very keen about them. In fact, you can be able to write in a red pen. You can be able to write in a red pen. For the retained earnings, you take the pre-acquisition. For the retained earnings, you take the pre. So write in this case pre-acquisition. The retained earnings. You can be able to write. You see this statement here is very important. Take the pre. Take the pre. The ones that were there, the retained earnings that were there before you acquired. Those are the ones you consider. You can be able to write this one in red pen or you underline it. That pre, if you forget it, then you'll mess with your calculation. And also it is sometimes it is very challenging to, it can confuse you to get it, but once you get used to it, you'll just easily be able to. These are the pre-acquisition retained and the retained earnings of the subsidiary before the parent company acquired it. So those are the ones you consider. But now the ordinary share capital, you don't think twice. Just pick the one that in this case has been indicated is there for, in this case, what? The subsidiary, even the share premium. Then the pre-acquisition, what? Retained earnings. Another, in this case, you take pre. In this case, exactly what? The reserves, the pre-acquisition reserves. The pre-acquisition reserves. So you add them. Then once you have the total, you're likely be able to get the total here. Then you put this side. You deduct. You deduct from that side. You total them, then you deduct the other side. Once you deduct it, in this case, you'll be able to have what? The full goodwill on acquisition. The full goodwill on acquisition. Full goodwill on acquisition, which will be the figure you'll be able to get there. The full goodwill on acquisition. So there's something in this case you have to be very keen. when you just see in the additional information, in this case, the examiner won't actually tell you that I want you to use the full goodwill method. It will be for you in this case to be very smart enough and know he wants in this case for you to use the full goodwill method. And how will you be able to know? In the additional information, whenever you just see the examiner has actually been able to tell you the fair value of NCI, this statement will be very common in the questions. It will tell you in this case, the fair value of the NCI. The fair value of the NCI was 600 million. The fair value of the NCI on the date of acquisition was 600 million. That's the statement you'll be able to see in the additional information. Don't think twice. He wants you to use what? The full goodwill method. But in this case, he won't tell you. Examiner will never tell you. He won't tell you that in this case, you are to calculate goodwill, use the full goodwill method. But what will happen? The additional information will see they have given you this thing. The fair value of NCI. When you see that they're saying the fair value of the NCI, you need to start smiling because they have already given you a hint of what you're supposed to use to calculate what goodwill or which method you're supposed to use. You're supposed to use what? So fair value, this case means what? Full method. Fair value of the NCI is given means you use what? The full method. The full method. That's how you'll be able to know. In this case, you are forgetting which method am I going to use when you say the article language. The fair value of NCI of the subsidiary on the date of acquisition was 600 million. He wants you to use what? The full goodwill method, but he won't tell you directly that in this case, use the full goodwill method to calculate goodwill. No, he won't tell you. He won't tell you. He won't tell you. So therefore, in this case, this one, we are going to say it will go to the consolidated statement of financial position. So like that, it will go there. Therefore, once we do an illustration, we'll be able to see how it goes there, how it is calculated, and eventually it goes there. So you can go now in this case to the other method number 2. We call it the partial method. This one now is partial. It's partial, not the full one. Is considering the entire goodwill, but this one is just partial. Just partial. It's just partial. So number 2, the partial methods. The partial method. So the partial goodwill method. The partial goodwill method. The partial goodwill method. The partial goodwill method. Under the partial goodwill method, so you can be able to write something small before we write. This is where only the parent goodwill, this is where only the parent goodwill is recognized. This is where only the parent goodwill is recognized. This is where only the parent goodwill is recognized, and the non-controlling interest is measured. This is where only the parent goodwill is recognized, and the non-controlling interest is measured at their proportionate share. This is where only the parent goodwill is recognized, and the non-controlling interest is measured, at their proportionate share of the fair value of the subsidiary net assets. Hope you've been able to write that. This is where only the parent goodwill is recognized, and the non-controlling interest is measured at their proportionate share of the fair value of the subsidiary net assets. Of the fair value of the subsidiary net assets. It is determined as follows. So this one, this is how you'll be able to determine it. It's not the most common in the exam, but it can be there once in a while. It's not the most common in the exam, but it can be there once. The examiner likes that other one, full goodwill. He likes that other one, but he can surprise you and bring this one. This one you start with the purchase consideration. You can surprise you and bring this one. You start with the purchase consideration. Then you don't actually consider the fair value of NCI there immediately. You in this case do what? Deduct the net assets acquired. You in this case less the net assets. So here there's no fair value of NCI that you add. It's not a full goodwill method. So less the net assets acquired. The net asset acquired is just the same, like the ones we've been able to talk about. In this case, you take the ordinary share capital, and we will take the ordinary share capital, and put there the amount. We have share premium. These net assets you're basically picking for the subsidiary, because you are acquiring the ones acquired, you are acquiring the subsidiary. So you just go to the equity part of the statement of financial position of the subsidiary. You'll get them there. So you just pick them. So this one, you just pick it. So the ordinary share capital, the share premium, you'll also pick it. But I've been able to say for the retained earnings, you need to take the pre. And of course, I told you can even be able to put a red pen there. Because if you forget that pre, your calculation of goodwill, things would have gone marambas there. So in this case, you say pre-acquisition retained earnings. Pre-acquisition retained earnings. Then in this case, we have what? The pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves. So in this case, get the total there. And get the total there. We can get the total there. Get the total there. So once you get the total there, once you get this total here, remember having to say in this case you consider what? The proportionate share. Proportionate share of the fair value of the subsidiaries is what? Net assets. In this case, you'll multiply this one. You'll multiply this one by the percentage of control. You see that figure you get there, the total value of the net assets acquired. You multiply, you likely multiply by this figure because you're taking the proportionate share. It is not full goodwill. You're not having to consider the goodwill of, in this case, what? The subsidiary. So in this case, they multiply by the percentage of control, multiply by percentage of control. You'll multiply by the percentage of control. Hope you've been able to put the bracket there, then you can squeeze it. You can be able to squeeze it. So I would have actually at least been able to put this one a bit far away here so that you could have been able to see. So this one is the purchase consideration. Then you're having to say multiply by the percentage, by percentage of control. Then once you multiply, you'll be able to get a figure here. Then once you deduct, you'll be able to get what? You'll be able to get now the goodwill. You'll be able to get now the goodwill. So you're not having to consider the goodwill of, in this case, what? The subsidiary. That's why you can be able to see that this is where only the parent goodwill is recognized. And the non-controlling interest is measured what at their proportionate share of the fair value what of the subsidiary net assets. At the fair value of the proportionate share of, in this case, what? Proportionate share of, in this case, what? The net assets. And then in this case, these are likely be able to get what? The goodwill here under the partial method, under the partial method. So in the exam, if you see this now how you'll be able to know they want you to use the partial method, right? You'll see somewhere, you'll check, and in this case, you won't actually be able to see that the fair value of the NCI, you've not been given that. But somewhere, the examining the additional information will tell you something. You'll be able to say that in this case, the NCI, it will tell you the NCI is measured at their proportionate share of the fair value of the net assets. When you see that statement in the additional information, they want you to use the partial method. It won't also tell you in this case that he wants you to use the partial goodwill method, but in the additional information, they won't tell you the fair value of NCI. They'll tell you in this case, the NCI is measured. In this case, if they tell you the NCI is measured at the fair value, if they tell you the NCI is measured at the fair value of this amount, they want you to use what? The full goodwill method. But in this case, you see that in this case, the NCI is measured at the proportionate. Is measured at what? The proportionate share in their net assets, proportionate. So P, they want in this case to use what? The partial. They want you to use the partial. When you see that proportionate in the additional information, they want you to use what? The partial method. Although it is not that common, but in this case, I think it is one of the questions in the past papers, one or two, there are not many. Most of the questions in the case, it will likely be what? Use of the full goodwill method, use of the full goodwill method, use of the full goodwill method. So pardon, what am I pardoning? So where should I repeat? What am I pardoning? Where should I end up having to repeat? Where should I end up having to repeat? Statement under the factor goodwill. So let me repeat it then. Statements under the factor goodwill. So this is where only the parent goodwill is recognized. This is where only the parent goodwill is recognized. And NCI is measured. And NCI is measured at their proportionate share. And NCI is measured at their proportionate share of the fair value of the subsidiary net assets. This is where only the parent goodwill is recognized and the NCI is measured at their proportionate share of the fair value of the subsidiary net assets. Fair value of the subsidiary net assets. Of the subsidiary net assets. Yeah, so that's in this case how you end up having to do what? Calculate goodwill. So I'm going to leave just a question you'll have a look at it. I'm going to leave a question, you'll just have a look at it. I think there was a question that we wanted that computation of goodwill. I don't know whether I'm able to get it here. Just wanted computation of goodwill. The question which just wanted computation of goodwill. Let me see if I can get it here. Yeah, you can look at there's a question here. There's a question for December 2024, question number 2B. So just have a look at it. But I think I'll be able to December 2024, question number 2B. I think Roman 1. So because I know it will bring challenges for you, but you just have a look at it. Try to have a look at it and see whether you can be able to calculate it. So if you're able to calculate it, you can even share and see whether you've been able to get a goodwill. So December 2024, question number 2B, Roman 1. 2B, Roman 1. December 2024, question number 2B, Roman 1. Question number 2B, Roman 1. You can even try Roman 2. You can even try Roman 2, but of course I know because you haven't actually been able to do a comprehensive illustration, it might actually maybe give you some challenges, but you try and see whether you can be able to get that one. You can be able to hack that one. You can be able to hack that one. So in this case, in our next class, we look at, and there's another key computation of, in this case, what retained earnings. Retained earnings, then in this case also we have what we call the non-controlling interest. These are very two key computations that in this case you must actually be able to mark how you can be able to calculate them. So apart from goodwill, apart from in this case what goodwill, which in this case we've just been able to look at, and then through that illustration, you'll be able to know how you can be able to come up with the goodwill. These are three key computations. If you can be able to master them, then you are good. You are very good at, in this case, what group account. So in this case, once we complete on looking at that illustration of goodwill, I would like us very quickly in this case to look at how you do the NCI, and in this case, how you do the retained earnings. So the retained earnings, this one will likely appear as an equity item in the consolidated statement of financial position. So we normally work it out as one of the key workings. Then also NCI, it normally appears in this case what under the equity item. So these two, they appear under the equity items. The NCI is basically what the parent company is not able to control. Is basically what is having to belong to, is part of the net assets basically belonging to, in this case, what? Belonging to, in this case, the minority shareholders. Like in this case, if the company has acquired 70%, it means the company is not able to control 30%. And therefore, they have a share in the net assets. They have a share in the net asset. This is basically what we calculate under what? The NCI. So we take their share in the net assets. Then in this case, we consider any other costs, benefits, changes in what? In the equity items. Then in this case, we add on it, then you can be able to get the NCI. So these ones, they normally appear as what? Part of the equity items in the consolidated statement of financial position. While this one normally appears as an asset. It normally appears as an asset. So while this one appears as equity, this one normally appears as what? As an asset. So there are the three key computations that in this case is very important you understand how you can be able to come up with them. And be able to come up with them. So in this case, we'll be able to look at how you come up with the retained earnings, then how you come up with the NCI. Then in this case, once you do this one, we'll be able to handle a comprehensive, now in this case, what? A comprehensive illustration. But you just try to look at this one, which Roman 1 basically wants you to come up with goodwill. Then of course, I think Roman 2 wanted you to come up with the, it is the statement of profit or loss. You can also be able to try whether you can be able to come up with the statement of what? Profit or loss. And see whether you can actually be able to get it, whether you can be able to get it. But if you want to be able to get it, no problem. So you will just, in this case, realize it is very easy to do it once we can be able to tackle it in what? In class. Otherwise, let me end there. You try to comprehend what you learned. Try to comprehend those adjustments you've actually been able to learn, because now moving forward, we'll be able to do a number of illustrations and you'll actually be seeing those adjustments. They'll be appearing as the most common. They'll actually be appearing as the most common. So let's end there for now. So unless there's a question, let me say nice weekend. 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 Nice weekend. So if you can manage to do that, you can share so that you can be able to have a look at it. If you can manage to do it, you can share or you can be able to have a look at. Just use the format you've been able to indicate there and see whether you can be able to do it. If you can't do it, no problem. You'll be able to look at it on Tuesday. So any question? Any question? Any question? Any question? Any question? Any question? Yeah, so if there's no question, nice weekend. So we catch up later. Enjoy your weekend.